Well, let's dig into this report and exactly what this means here for the economy, what it tells us just about consumer, and obviously most importantly for the Fed. And for that, we want to bring in Tendayi Kapfidze. He's at Wells Fargo Chief Corporate Economist, and Nathan Sheets, Citi Global Chief Economist. Great to have you both here at the table with us. And Tendayi, let me start with you just in terms of how you're looking at this report and most importantly, how you think the Fed is looking at these numbers.
Yeah, I think it's a pretty good report, right? So you get inflation coming in a little bit softer than expected. There had been some concerns that because of seasonality and because of some changes to the way they calculate healthcare, that you might get a little bit of a pop this month. So it's a good thing that that didn't happen. As far as the Fed is concerned, though, we have 7 Fed speakers today. So there's going to be a lot of Fed speak. I think they will all still be emphasizing that the Fed will raise rates if needed, right? They kind of have to until inflation is actually down. So great numbers, I think, but I think the Fed speakers will still have a bit of a bias towards making sure that everybody understands that rate hikes are still an option, even though that may no longer be the base case.
Nathan, I want to bring you in here. The next Fed meeting, December 12th through 13th here. Does this change the tenor? Does this change the dialogue in the conversation?
You know, I think the markets, I think the Fed was worried that this could be as high as a 0.4. And to get a 0.2% increase on the core is a very positive development. And I do think on the margin that allows Jay Powell and his colleagues in December to be a notch less hawkish than they would be otherwise. Now, that said, is the Fed going to be careful? Is the Fed going to avoid saying job done, mission complete? Absolutely. And I think Jay Powell will continue to try to find ways to preserve this kind of hawkish hold construct. But as time passes, it's getting harder and harder for him to communicate the hawkishness in the whole, especially in the face of ongoing disinflation in the economy.
Tendayi, when we talk about what needs to happen in this final mile here, that last mile in the fight to get inflation back to that 2% target, when we talk about potential timeline, exactly how aggressive maybe the Fed will ultimately need to get if they do need to continue to raise rates, what does that look like? And I guess how do you think the Fed is trying to balance that, what they have been saying now for obviously quite some time here? They're doing everything they can to get inflation under control, but they also are trying to do it without sending the economy into a recession.
Yeah, I think if you look at the components of inflation, particularly if you look at housing, which has been the hottest part of inflation for the most part of this year, but we know from some of the real-time indicators that the disinflation process in housing and rents is kind of a given, right? So it's going to continue through most of next year. So I think in terms of what's the future path of inflation, you look at housing, and I think you're going to be fairly confident that this disinflation process will continue. But as Nathan said, right, they're trying to do this hawkish hold, and I think they feel that they have to do it because in a sense, you kind of fight the last battle until you're confident that you've won it. But certainly I think they need to start being a little bit cautious here because as we continue to see disinflation, even without more rate hikes, right, the real rate continues to increase and is going to become more and more restrictive on the economy. So I think they need to start thinking about maybe not publicly communicating when they might start to, ease and probably mid next year might be a good time to think about doing that.
And considering that food, shelter, energy, the basic needs for every household. So, as you're continuing to watch that be one of the largest contributors to this inflation print that we've gotten month over month, and specifically in shelter, how does that continue to impact those other discretionary items that consumers are going into this holiday season trying to determine, all right, am I spending $25 on a person or am I spending $50 on a person? Or are they getting anything at all?
Yeah, this is a great question, a very important one. As some of those necessities start to disinflate more, that does open up a greater scope for just discretionary spending and continues to support the economy. And when we step back and think, what is the underlying driver of this strong economy? And it's the resilient consumer. And what's driving the consumer is the strong labor market, ongoing wage growth, and the fact that consumers have more resources, more money in their pockets to spend. And as inflation comes down, those increases in wages relative to the inflation rate, the real wage, becomes increasingly supportive. So I think this is the move. We focus on the core because we think it's a better forecaster of where inflation's going to go. But the headline and these necessities that are included there are also critical for these kinds of reasons that you point out.
Tendayi, you mentioned the fact that maybe we could see a cut here in the second half of next year. When we talk about maybe continuous cuts, I guess, what do you see that looking like? Because we certainly have seen predictions that diverge pretty broadly here just in terms of the timing of the cuts and how aggressive maybe the Fed will ultimately get.
Yeah, I think that has a lot to do with how the unemployment rate and the labor market evolves, right? So we've had a focus the past few years, obviously on the inflation side of the mandate, and the labor market has been really strong and really resilient. The past few months, we've started to see an uptick in the unemployment rate. Now, crucially, that uptick has been because of growth in the size of the labor force, right? It hasn't been because of people getting laid off and losing jobs, right? If we start to see a transition, and we've been seeing the labor market slow down, we've seen the jobs openings rate slow down, we've seen the quits rate kind of increase. If we start to see a weakness in the labor market that is driven by people being unable to find jobs versus the growing size of the labor force, as we've seen the past couple of months, then the Fed needs to start to shift the focus from inflation to the labor market, and that's what's going to determine the pace of any rate cutting
Do you
cycle.
anticipate that we will see that material weakness in the jobs picture?
We're not seeing it now, right? And I think as long as the consumer remains strong, I think one of the things that's happening is that we've had all these kind of pent-up savings and all the transfers that people received. Now, in at the lower kind of cohorts of the income, a lot of that money has been spent, but there's a lot of it left at the higher cohorts of income, and there's a lot of it left on business balance sheets and state balance sheets, and that spending passes through the labor market to the rest of the folks who no longer have savings, right? So as long as we continue to see, I think, strong consumer spending from the high end, supporting the labor market, then we may not see a material deterioration in the labor market.
In terms of that propensity to spend as well, in some of those discretionary categories, and I think back to the quote from just this morning from Home Depot as they announced earnings, they said that they have seen pressure in certain big ticket discretionary categories. And for a lot of companies that we've been tracking over the course of this earnings season, it's whether or not student loan payment resumption is impacting the discretionary categories. It's whether or not Ozempic is impacting if I'm eating food away from home that could pass through to an inflationary print. And so all of that considered, is there one prevailing kind of outsized force right now that we're seeing start to play out when it comes to prints like this?
Yeah, great question. My sense is that coming out of the pandemic, there was a big bulge of consumer spending, especially consumer spending associated with services. Coming out of the pandemic, people hadn't had those services experiences for several years, and they've been paying up for it. And that has supported consumer spending, growth, the economy, but importantly, also inflation over the last 18 months or 2 years. And that is now transitioning. And I think one of the big questions is, does that services spending become more goods spending? And we're seeing some of that. Or does it translate into an overall softer pace of consumer outlays? And I think that's what the corporates are worried about. And that question is also tied closely into this issue of what happens next to the labor market.
Right.
So what do you think this ultimately tells us just about the ability that the Fed could have here to orchestrate a soft landing? How likely is that?
Yeah, I think the elusive soft landing might be in play. I think certainly the way the data is evolving, it seems like that's the most likely scenario. The economy can always surprise you, but I think Jay Powell and co. got to be pretty happy with these numbers today.
All right, we're going to continue to track to see if the markets are happy with these numbers today. At least on the initial outset, it seems that the future is moving in positive territory. Thanks so much for joining us here in studio. Tendayi Kapfidze, who is the Wells Fargo Chief Corporate Economist, and Nathan Sheets, Citi Global Chief Economist.